Oil is supposed to react to tension. That's the rule most people assume. When friction rises in the Middle East, when diplomatic strain intensifies between major players, markets are expected to respond immediately. Traders price in risk. Energy analysts warn of supply disruptions. Prices move higher. That's the pattern we've been conditioned to expect. But this time, something unusual happened. Despite rising tension between the United States and Iran, oil prices didn't surge. They didn't spike. In fact, they moved lower. And that should make you pause, because when markets stop reacting the way they used to, it usually signals something deeper than a single headline. Markets are not emotional. They are probability machines. When they change behavior, it's rarely random. So the real story isn't about a weekly fluctuation in the price of crude. The real story is about what that reaction, or lack of reaction, reveals about the global energy system in 2026. For decades, oil was the most sensitive geopolitical signal in the world. Instability in key producing regions could ripple through the global economy within hours. Governments watched it closely. Central banks adjusted policy around it. Investors treated it as an early warning indicator of broader instability. Today, that sensitivity appears muted. Why? Is the risk being underestimated? Has the market become complacent? Or has the structure of the energy system quietly evolved? If oil no longer responds automatically to visible geopolitical friction, then either the threat to supply is lower than it seems, or the system itself has become more resilient. And if the system has changed, that shift carries implications far beyond a single week of price movement, because when the signals change, the structure behind them usually has changed first. Let's unpack what's really happening. To understand why oil isn't reacting the way many expect, we need to step back and remember how it used to behave. For decades, oil functioned as the world's early warning system. When instability surfaced in major producing regions, prices responded almost immediately. It didn't require a confirmed disruption. The possibility alone was enough.
Traders priced in risk quickly, sometimes aggressively, because the system had very little margin for error. Supply was geographically concentrated. A significant portion of global production came from a relatively small number of countries, many of them located in politically sensitive areas. If something interrupted production or shipping routes, there weren't many alternative sources ready to compensate. And global demand kept rising. Industrial expansion, population growth, and the rapid development of emerging economies created a steady upward pull on consumption. The market assumed that tomorrow would require more oil than today. That assumption amplified every supply concern. The system was tight. Low spare capacity meant that producers were already pumping near their limits. Inventories weren't always comfortable. Transparency was limited. Data moved slower. Rumors moved faster. So when tension escalated in the Gulf region or diplomatic relations deteriorated between major actors, the market didn't wait for confirmation. It reacted preemptively. Because the cost of being wrong was high. If supply truly dropped and you were unprepared, prices could surge dramatically. Inflation could follow. Economic growth could slow. Policymakers feared energy shocks because they had seen the damage before. In that environment, sensitivity wasn't irrational, it was logical. Oil prices weren't just reflecting present conditions, they were reflecting vulnerability. The market understood that even a small disruption could ripple outward, affecting transportation, manufacturing, food production, and financial stability. Energy sat at the center of the global economy, and the system had limited buffers. That was the old model. High dependence, limited flexibility, rising demand, concentrated supply. Under those conditions, tension almost automatically translated into higher prices. But that model depended on structural fragility, and over the last decade and a half, that fragility has been quietly reduced. Which brings us to the real shift, not in headlines, but inside the energy system itself. In the next section, we'll look at what changed beneath the surface, and why those changes may matter more than any single diplomatic confrontation.
If the old model was built on vulnerability, the current model is built on buffers. The transformation didn't happen overnight. It unfolded gradually over more than a decade, and because it was gradual, many people didn't fully register how much the structure had shifted. The first major change was geographical diversification of production. The United States dramatically increased its output over the past 15 years. What was once a heavily import-dependent country became one of the world's leading producers. That shift alone altered the psychology of the market. Supply was no longer concentrated in quite the same way. When production is distributed across more regions, the system becomes less fragile. A disruption in one area doesn't automatically translate into a global shortage. The second change was capacity and storage. Strategic reserves expanded. Private storage capacity increased. Data transparency improved. Weekly inventory reports now give traders clearer visibility into supply conditions. The market has more information than it did decades ago, and information reduces panic. If inventories are high, short-term tension feels manageable. If spare capacity exists elsewhere, the probability of prolonged disruption declines. The third shift was on the demand side. For years, the dominant narrative was steady global growth. Industrial expansion in Asia, rising consumption across emerging markets, and expanding transportation networks created confidence that demand would continue climbing. That assumption is no longer automatic. China's growth has moderated compared to its peak years. Europe's consumption patterns have shifted. Energy efficiency improvements reduce the amount of oil required per unit of economic output. Electric vehicle adoption, while not replacing oil entirely, is slowly reshaping expectations about long-term demand. The result is subtle but important. Demand growth feels less inevitable, and when demand growth softens, the system can absorb supply risk more easily. The fourth transformation is financialization. Oil today is deeply integrated into global financial markets. It is traded not only by producers and refiners, but by hedge funds, institutional investors, and algorithmic systems that operate on models of probability.
These actors don't respond to headlines alone. They assess likelihood. If tensions rise but the probability of a meaningful supply disruption appears low, the market may barely react. In some cases, it may even move lower if other factors, like inventory builds or weaker demand forecasts, outweigh geopolitical risk. This is a crucial distinction. The old system reacted to fear of disruption. The current system weighs disruption against buffers, and buffers change behavior. The market now asks a more calculated question. Will barrels actually disappear from the global supply? If the answer appears to be probably not, then prices remain stable or even decline, despite visible tension. That doesn't mean geopolitics is irrelevant. It means geopolitics is filtered through a thicker layer of structural resilience. The energy system today is not immune to shock, but it is less reflexive. And when reflexes weaken, thresholds rise. It now takes more than diplomatic strain or regional friction to move oil dramatically. It takes a credible threat to physical supply, something that meaningfully alters global balances. So when oil prices fall during visible geopolitical tension, the message isn't that the market is ignoring risk. The message may be that the system has evolved. And if the system has evolved, then the signals we're used to interpreting need to be recalibrated as well. In the next section, let's apply this framework directly to the current case and examine why Iran, specifically, is not triggering the type of reaction many would expect. When people hear about rising tension between the United States and Iran, there's a historical memory attached to it. In past decades, instability involving Iran had immediate consequences for global oil supply. The country has long been a major producer, strategically located near one of the world's most important energy transit routes. Any disruption there once carried global implications. But today, the context is very different. First, Iranian oil has been operating under constraints for years. Sanctions, restrictions, and export limitations are not new variables. Markets have had time to adjust to them. When something is already embedded in the system, it doesn't shock the system.
In financial terms, much of the risk is already priced in. Second, global trade networks adapt faster than they used to. Even under restrictions, oil flows don't simply disappear, they reroute. Discounts compensate buyers for risk. Shipping paths change, intermediaries emerge. The market finds workarounds. That flexibility dampens volatility. Third, other producers monitor price signals closely. If prices rise sharply, additional supply can respond more quickly than in the past. This doesn't eliminate risk, but it shortens the time window in which a shock can dominate pricing. The system has become more dynamic. There's also the issue of probability. Markets distinguish between tension and disruption. Diplomatic strain or military signaling does not automatically equal a loss of supply. Traders assess whether infrastructure is likely to be physically impacted: pipelines, export terminals, shipping lanes.
If the perceived probability of real disruption remains low, price reactions remain contained. This is the critical shift. In earlier decades, perception alone could move oil significantly because the system was fragile. Today, perception is filtered through data, inventory levels, spare capacity, alternative supply routes, and demand forecasts. The market's core question is simple. Will global supply meaningfully shrink? If the answer appears to be no, even amid visible tension, prices may stabilize or fall if other forces dominate. So the muted reaction isn't necessarily complacency. It may be a sign that the energy system has developed a thicker layer of resilience. And that resilience changes how power operates within the market. In the final section, we'll step back and look at what this means for the future of energy influence and why quieter markets don't always mean lower states.
It may mean the system has matured. For decades, oil sat at the center of global vulnerability. Supply was concentrated, demand was rising predictably, spare capacity was thin. Under those conditions, sensitivity was rational. Markets reacted quickly because the consequences of disruption were severe. Today, the architecture looks different. Production is more diversified, strategic reserves are larger, information flows faster, demand growth is less predictable. Financial markets filter risk through models that measure probability instead of reacting purely to headlines. The system now contains buffers, and buffers change behavior. When resilience increases, volatility often decreases, at least in response to perceived risk. It takes a more credible and measurable disruption to move prices significantly. That doesn't mean energy has lost its geopolitical relevance, far from it. Energy still shapes alliances, it still influences national strategies, it still determines economic stability in many regions. But influence inside the energy market is increasingly defined by capacity and flexibility rather than fear alone. Who can produce reliably? Who can adjust output quickly? Who can absorb short-term shocks without panic? These are the questions that now shape pricing dynamics. Markets are not emotionless, but they are adaptive. When structural vulnerability declines, sensitivity declines with it. And that brings us back to the original question. Oil was supposed to rise. It didn't. That divergence isn't random. It's a signal. Not necessarily a signal of lower risk, but a signal that the rules governing energy reactions have shifted. When markets grow quieter, it doesn't mean tension disappears. It means the system has changed how it processes that tension. And when a system processes risk differently, power inside that system evolves as well. The real story then isn't about 1 week of falling prices. It's about resilience, and how resilience reshapes the balance inside global energy markets. Because when the signals change, the structure behind them has usually changed first. And that's where the deeper transformation is happening.